Hi, and welcome back to Accounting 161. My name is Stan. This is going to be a look at Unit 3 of the course, and it's about adjusting entries at the end of the accounting period. This lesson is going to focus on adjusting entries, what they are, and the different types of adjusting entries that we need to make. And then we're going to look at actually making journal entries for these adjustments. So let's take a look at step 5, journalizing and posting or adjusting entries to the ledgers. The process of preparing journal entries and also of posting to ledger accounts is exactly the same as steps 2 and 3 in the accounting cycle. The key lesson in this section here, though, is adjusting entries. So let's take a look at what adjusting entries are. So what are adjusting entries? I'm actually going to give you the definition of adjusting entries in two parts. Part one, I'm going to give you now. I'm going to explain why we need to make adjusting entries, and then I'll give you a more full explanation a little bit later in this presentation here. So part one of my explanation, these are journal entries made at the end of the accounting period to record unrecognized income or expenses for the period. And the first question that would come to me is, why would we have unrecognized income or expenses for the period? There's actually four concepts that I need to explain to you. I'm going to go through each and every one of these. First is time periods, the fact that accountants prepare reports given certain time periods. Second, and probably more importantly, is the concept of accrual-based accounting versus cash-based accounting. From that, I'm going to discuss two concepts in more detail, the revenue recognition principle and also the expense recognition principle. So first, let's take a look at time periods. Accountants will break up the year into specific time periods, and that's most commonly on a monthly basis, meaning they will complete the accounting cycle once every month or 12 times in a year. In addition to completing the accounting cycle once every month, companies often will prepare reports on a quarterly basis. Publicly traded companies are obligated to prepare interim quarterly financial statements, which simply mean 3 months of data. And they will also prepare annual statements, which is simply collating 12 months worth of data to prepare the annual financial statements. Most commonly, the business fiscal year is January to December, starting in January, ending in December. And for most governments, at least in North America, the fiscal year starts on April the 1st to March 31st. So if anyone works in government, you may notice the different fiscal year or reporting period for that institution. The next concept I want to discuss is cash-based versus accrual-based accounting. So first, cash-based accounting. Revenues are recorded when cash is received. Expenses are recorded when cash is paid. It's really easy, and a lot of small businesses actually run their companies using cash-based accounting. However, cash-based accounting is not in accordance with IFRS or with ASPE. So if you are a publicly traded company, then you cannot do cash-based accounting. The alternative is accrual-based accounting. Transactions are recorded in the period in which they incurred. And so we will recognize revenue when you perform the service. We'll recognize expenses when they were incurred, not when we paid for them. And this is in accordance with IFRS and ASPE. Let's take a look at accrual-based accounting in a little bit more detail in the next couple of slides. Let's take a look then at the revenue recognition principle. The principle states that we should recognize revenue when the company meets a performance obligation, when we've done the work, or when the risks are substantially transferred to the buyer. So what does that mean then? First off is when we sign a contract with one of our customers, that does not represent revenue, nor when we receive cash for that contract. Neither of those transactions represents revenue. We will recognize revenue when the performance obligation is satisfied, meaning when we have done the work. That's when we will recognize the revenue. Lastly, then, let's take a look at the expense recognition principle. This principle states that we should recognize expenses in the period in which we made the effort to generate the revenue, not when we paid the invoice. And so in this case here, then, we will recognize the expense when we've made the effort to generate revenue, not when we've paid the cash or not when we've signed a contract to uh, to receive any services. So now I'm going to come back to my definition of adjusting entries, and this is part 2 of my definition. Adjusting entries, then, are adjustments to the trial balance to ensure that the revenue recognition principle and the expense recognition principles are followed, and it is required every time a company prepares financial statements. This results in 3 different types of adjusting entries, and we are going to look at each and every one of them in more detail. First are prepaids. Another term to explain this is called deferrals. And these are where we have made prepaid expenses. We've made the payment before we receive the benefit, or unearned revenue when a client prepays their expenses, yet they have not received the service yet. Secondly is accruals, accrued revenue and accrued expenses. And then finally is estimates, amortization or depreciation on long-term assets. Let's take a look at each and every one of these one by one. Let's start off with prepayments, or another term to describe that is a deferral. There are 2 types. One is a prepaid expense that you will make to another supplier. These are expenses paid in cash before they are used, and the most common example of that is insurance. You pay for insurance at the beginning of the term, but you use the insurance over the course of 1 year, and so that's how you will expense the insurance expense. The other example is the exact opposite, where one of your customers will give you cash before the services are performed, and that's known as unearned revenue. So they will give you cash at the beginning, maybe at the time of signing of the contract, but remember, that is not revenue yet. Revenue is recognized when you have completed the work. Now I've made up 2 examples of a prepaid expense. The first one, on August 1st, 2023, XYZ Company paid Concord Insurance $2,700 for insurance coverage ending July 31st, 2024. It's a 1-year term. And the question is then, how much should XYZ record as an expense for the month of August 2023? Now, for this particular transaction, there was actually something that happened beforehand at the beginning of the month, and that is that they made a payment to Concord Insurance of $2,700. So you can see here then, this will involve a debit to an asset known as a prepaid expense. And we used cash to pay for it, and therefore a credit to cash. At the end of August, we will recognize 1 month's worth of insurance expense. So $2,700 divided by 12, that works out to $225. And so each month we will expense $225 for insurance. And that involves a debit to insurance expense and then a credit to prepaid. You can see that over time, that prepaid expense asset is going to continually go down over the course of the year. Let's take a look at one more example. On August 1st, 2023, Acme Suppliers, one of your customers, pays you $5,000 up front for goods and services. But by the end of August, you are only able to complete half the contract. And so once again, on August the 1st, when Acme Suppliers has made the payment to you, we will recognize the receipt of cash. It will be credited to unearned revenue. Unearned revenue is a liability account. And it's a liability because we have not done the work yet. And so now then, at the end of August, we've only been able to complete half the contract. And so that's how much revenue we will recognize at the end of the month. We're going to debit or reduce the unearned revenue account, so our liabilities have gone down, and we're going to credit revenue. And that the August 31st transaction is the actual adjusting entry. Now let's take a look at the type of adjusting entries known as accruals. There are two examples of accruals: accrued revenue and accrued expenses. Revenues or accrued revenues are services performed but not yet received in cash or not yet recorded in your accounting records. And then accrued expenses, expenses incurred but not yet paid in cash or recorded in your accounting records. The most common example of an accrued expense are salaries. Let's take a look at two examples of accruals. First, you signed a contract to deliver $4,500 in services on August the 1st, 2023. In the month of August, you only completed 1/3 of the contract. It's important to remember that at the time of signing of the contract, that is not a financial transaction. We have not received any cash or such, so that is not a financial transaction. At the end of the month, when we've completed 1/3 of the contract, that is a financial transaction, and we will record that as showing on August 31st an account receivable, since the supplier has not made any payment, and we're going to recognize revenue of $1,500. One more example of an accrual. Your staffing costs are estimated to be $2,000 per day, including weekends for simplicity's sake. The last date on which you paid your staff salaries was August 25th, 2023. So you've made a payment to your staff on August 25th, 2023. But now it's the end of the month, and we need to record the expense that was incurred to the end of the month. We can do that by recording salaries expense. We're going to debit that by $12,000, and we're going to record a credit, a liability, salaries payable for $12,000. And so that becomes a liability that we will have to pay in the next accounting period. The final example of an adjusting entry is a little bit longer. So I want to make sure that everyone understands this topic. So what is an estimate? It's the process of expensing the cost of fixed assets or long-term assets to an expense account over its useful life. Remember that when we purchase long-term assets, which are assets with a life of longer than 1 year, we do not expense it at the time of payment. We have to expense it over its useful life. And this applies to intangible assets as well. There are actually 4 different methods of estimating depreciation. I'm just going to look at one called straight line depreciation, which is the simplest form. So let's take a look at my example for an estimate. On July 1st, XYZ Company purchased computer equipment worth $10,800 with an estimated useful life of 3 years. We don't know for sure if the useful life is exactly 3 years, but it's an estimate of its useful life. The company uses straight line depreciation to record depreciation expense. Before I go any further, I need to explain 2 concepts. First is straight line depreciation. It's estimated by dividing the book value or the historical value of the asset by its estimated useful life. And remember, its useful life is purely that, it's an estimate. So in this case then, we have computer equipment worth $10,800 divided by its estimated useful life of 36 months. So we get monthly depreciation expense of $300. The second concept I need to explain is the notion of a contra account. So for purposes of recording depreciation, the associated credit entry is going to be credited to a contra account called accumulated depreciation. This contra account is a special account and it is tied specifically to the computer equipment account, and it has no other use other than to record depreciation for the computer equipment account. When we do our accounting for depreciation, we do not credit the equipment account. So now let's take a look at the journal entry we will use. At the end of the month, we're going to record $300 in depreciation expense. That's our calculated monthly estimate. And then we're going to credit an account called accumulated depreciation. And that account is the normal balance will be the exact opposite of the asset account. So therefore the normal balance will be a credit balance. And in the next presentation, I'm going to show you how we present that in the trial balance. So those are the 5 different types of adjusting entries that you need to pay attention to at the end of the month. And it's important to remember that not all adjusting entries will be explicitly stated for you. And in many cases, you need to do the work to find the adjusting entry. But this is just a quick summary of the different types. First off then is accrued expenses and accrued revenues. Those are known as accruals. And you can see here that normally we will, you can see the debit and credit entries that we will make. The deferrals, prepaid expenses, and unearned revenue. Also, the journal entries that you will make, and then also amortization or depreciation in this case here. You can see here we're going to debit the expense account, but we're going to credit a contra asset account. And in our example that we looked at with computer equipment, that contra asset account is known as accumulated depreciation. Now that we've completed the adjusting entries, we're going to come back to, this time, an adjusted trial balance. And also, we're going to take a look at financial statements in our next video. We'll see you then.